Tech Swing Trade here again. Today I want to do a video on the reason most beginner option traders lose money and why 95% of all traders actually lose money. The biggest problem is a lot of people come into trading and they open their brokerage account and they are overzealous, they're emotional, and they get excited and really just want to make some money. And for a beginner in options trading, that isn't that knowledgeable of the different kinds of strategies and exactly how these options work and how they work against you. The easiest way and the fastest thing to learn how to do is to buy calls and to buy puts. So we would just consider that a naked buying naked calls or buying naked puts. So when you buy a call, I'll put a call up on here. So we just bought a call. That's basically 100 contracts. You got a control of 100 contracts and you are bullish on the position. So right here is 100 contracts of SPY call option. We bought a call option, and in order for let's go in. Let's see. In order for this to make money, actually, let's move this over. Let's get this into the money here. So actually, let's put this right at the money. So SPY is let's see, SPY is at 297. The market is not open right now. It's a Saturday, but SPY is at 297.97. So we're placing a call option pretty much right at the money. This call option is at 298. Now, if you look at our profit loss graph here, the green is where you start to make money. The 299 right where the green stops is your break even, and the red is where you lose money. So in order for this option even to make money, this is a 2-day. I got it expiring for the basically on Monday, even though the market's not open. This is just an example. So in order for this option to even start making money, it has to go up to 299. So it can't stay where it is. It can't go down. It has to go up, and it has to go up to over $299 for you to make even 1 penny. As you can see, the probability of profit on this options trade is 23%, which isn't good at all. And it would cost us $100, $102 in buying power in order to purchase this option. And you have a 77% chance of losing your money. So, and a lot of people go into these options trades blind. They don't understand the probabilities. They just look at it. They have a very strong opinion as to which way the stock's going to go, and they'll go ahead and place a call spread because it's very easy to do, and it's kind of instant gratification. You know, as the stock moves up, you start to make money, but if it starts to go down, you lose money too. So same goes for puts. Puts are exact same thing as calls. If you're buying a put, except for your directionally bearish, so you're anticipating the stock to go down. So we'll go ahead and clear this out, and I'm going to place a put. I'm going to buy a put, and we're going to buy it right out of the money, just like we did the call. So as you can see, now our money is to the downside. So when you're buying a put, you're anticipating the stock to go down. So if we place our put right at the money, which is 298, that put call is going to cost us $70, and we have a 36% chance on this one. So still very horrible odds. Now the only benefit to buying calls and buying puts is there's no cap to your potential profits. So if this stock can go away all the way to zero, and you're going to make money all the way to zero. Like as you can see here, max profit on this is $30,000. But in order for you to get that $30,000, this stock would have to literally go to zero. If we clear this out and we put a call, we buy a call at the money, our max profit is going to be infinity because this stock can go infinitely high. So the only advantage to buying calls or puts, naked calls or puts, is there is no cap on the profits. The higher the stock goes, the more money you make. Okay, with that said, I'm going to show you credit and debit spreads, which is combining buying and selling calls or puts. And there's a lot of advantage to that, and I'm going to basically visualize it to you here on the charts. Also, if you're not familiar with options, buying and selling, these uh, these calls and puts are going to expire worthless basically. Every day that goes by, this call is going to depreciate in value, and by the time it gets to expiration, if it's not in the money, that option contract is going to be um, of no value at all. So, all right. I'm using Tastyworks platform too. If you're not familiar with Tastyworks, I will leave a link in the video description below where you can sign up. If you're a beginner, it is one of the best trading platforms out there just because of the visual aspect of it, and especially if you're learning how to, you're just learning how to place these credit spreads, strangles, straddles, iron condors, butterflies. It sets all these trades up for you automatically, so it's very good for learning. Unfortunately, they do not have a paper trading version, but their commissions are cheaper than everybody else's, even the free options on TD Ameritrade and all that, because they're not actually free. They're 65 cents when you buy in, 65 cents when you buy out. Tastyworks does charge $1, but it's only when you buy in. It's 0 to close, so it still ends up being cheaper than TD Ameritrade, Charles Schwab, E-Trade, still a cheaper platform. So, all right, let's go ahead and I'm just going to go over the simplest strategy here. There is not to confuse anybody too much if you're new to this. The point being made before we go any farther, if you want to keep your money, stay away from buying naked calls or buying naked puts. It's a very hard way to make money unless you know the stock is going to go in your favor. Then they can be very profitable, but nobody knows which way the market's going. The market has a mind of its own. If you think you know, it's going to show you real quick that you don't. So let's go ahead and check what this vertical, well actually let's go, now there's 4 different versions. I'm not going to go into great detail about what all these are, but you can buy a call credit, a put credit, and call debit, and a put debit. One you're receiving a credit, and the other you're they're taking a debit. But typically in high RV situations, you're going to want to be trading the credit spreads, because basically you're collecting the premium on the sold option, and in a high volatility market, you can actually make a lot of good money, like going into earnings and stuff like that, or just volatile in general. So right here, we're going to put on a put vertical credit spread. We're buying a put and we're selling a put, and the direction of this trade is bullish, so we want the stock price to go up. And as you can see right off the bat, a probability of profit, just the way they set this up, is 68%. So we've already doubled our chances of making money on this trade. Now the credit you receive on these isn't going to be as good as, like, the return to investment isn't going to be as high. As you can see, we need to invest $35 in order for a $15 return. So you're not going to get your percentage of return isn't going to be as high on these, but you really should not take that too much into consideration, because it's a lot better than losing all your money. So 68% of the time on this trade, you're going to make $15, and you can adjust this, but typically a 68 is a good, if you're doing credit spread, 68 is a pretty nice place to start. 78, if you have a bigger account, I mean, if you're trading with thousands of dollars or hundreds of thousands of dollars, people like that, they're moving out to 87%, because they can make, I mean, they can make thousands of dollars, even though this is only paying $8 on a $42 risk. If you're playing with thousands of dollars, at $8 starts turning into a pretty good return. But typically I place my credit spreads right around the 70% mark. If it's a big trade or a more what I think might be risky trade, I'll give myself a little cushion. This is where the strike price is at. The strike price is looks like 298 is the strike price. So this stock can go all the way down. This stock can go down to 297, and I still get paid, or it can go up to infinity and I still get paid. So basically, you got 3 ways to win here. You can go down, you can stay where it is, or it can go up. and you're still going to collect. You're still going to collect this on this particular trade with almost 80% odds of winning. You're still going to collect this $9 here. And you can adjust the expiration dates. Like this is only a 2-day expiration. So I mean, if you're doing these short-term credit spreads and collecting, I don't know, what would this be here? And that's almost 25%. We'll say 18%. When you're collecting 18% every 2 days, you can actually pile up some money pretty quick, providing you're right on the direction, or even partially right. You don't even have to be right all the way on the direction. You can be partially right. So these are what I usually stick to. Also, iron condors is another neutral strategy. I'll go into those a little more in another video, but let's throw on another one of these. Let's do a call credit spread, which is the same thing, except you're bearish on the stock. You think the stock's going to go down. You got a little leeway to the upside. Stock stays where it is, you make money. Stock goes down, you make money. 70% odds. You got 70% odds on this, and $22 return off 20 investment with a 70% odd. That's a very good. That's actually a very good trade right there. Now the reason why this one's probably paying more than the bullish spread is because the market makers are probably predicting this. There's more chance of the stock going up. That's how these option prices work. So the market makers are pricing these options a little differently. So you're getting a better return because the chances of it staying down are probably less than the chance of it going up. So usually if it pays more, your odds aren't quite as good. So, but anyways, there's an example of your call credit spread and your put credit spread. And debit spreads are the same thing. The only difference is you're getting a debit instead of a credit. And the difference in these two, I'll touch on that real quick, I guess. The difference in the credit and the debits, just real briefly. Basically, in a high IV environment, your premiums are going to be a little higher. So when you're selling these puts, you want them to expire worthless. So the more money you collect on them, the actual more money you're going to make. So in a high IV environment, implied volatility, when there's high implied volatility, you're going to get a bigger credit on these puts you're selling. So when they expire, you actually end up making money, or if you close the trade out early, you'll end up making a little more money. Whereas in a low IV environment, it's going to be the complete opposite. So a debit, you'd make off a little better with a debit spread. So high IV, you want to be doing credit spreads. Low IV, you want to be using debit spreads. And I'll probably dedicate a whole video just going over debit and credit spreads, because there's actually a lot more that goes into that, than that. And just to give you a quick visual, I like playing these iron condors a lot. Basically, this is just playing two spreads is all it is, spread out. It's actually four trades. You're placing 4 trades. Basically, you got a credit spread over here, and you have a credit spread over here. You got a put credit spread and a call credit spread played together, and you're basically cornering the market. So this is a neutral play. It can go up. It can go up. It can go down. It can stay in the middle. As long as it doesn't go out of this range, this trade is gonna pay you money. So these are very reliable trades. The return on them isn't quite as good, but the probability of profit is, and you don't have to take a direction on the market, which is pretty nice, because nobody can predict which way the market's going to go, and if you think you can, the market will chew you up and spit you out very quickly. I mean, that is unless you're a day trader and you're playing off the news and stuff like that, but if you're swing trading or you're investing, anybody's guess is as best as mine. So these neutral plays are a very safe way to grow a small account. As you can see here, we got 82% odds, our probability of profit. We're not going to make much on it, be $8 out of 42, but still, I mean, that's a 16% profit about, which is that's way better than you're going to make on any IRA or any kind of retirement or even bank savings account. So there are some pretty safe ways to make money trading options. just a matter of doing your homework and watching your videos. Don't get emotional, don't get overzealous, and don't be tempted to uh, just do dumb stuff. Like, I'll show you what would be dumb. Let's say we move. Let's say we move this iron condor. Let's say we move it in right, like way tight, real tight, like ridiculously tight. So we only have this little short area to be able to make money, and we only have an 18% chance of winning. But look, we only got to spend $6. So like, oh shoot, look at that, $6 and I can make $44, and that's what a lot of people do because they don't care. They're like, oh, if I lose $6, it's no big deal, but I can make $44. But what a lot of people don't understand is when this option expires, chances are it's going to expire worthless because it's not going to be in the zone. And when it does, these contracts are going to be in the money. And if they're in the money, you're either going to get assigned, and if you do get assigned, or even if you don't get assigned, you're going to get an assessment fee. If you do get assigned, you could possibly lose even more money, and they're going to put the calls or puts to you. You're going to have to buy those contracts, those actual stock contracts. So you could potentially end up losing a lot more than you initially invested, or your potential max loss was if you have to pay assignment or assessment fees on this trade, or if there's any extra collateral damage by getting assigned or assessed. So this is a horrible trade, and I've placed these before just to see what happens, and guess what? That's what happens. So highly advise against it. And I mean, if you're not in here looking to gamble and you actually want to invest your money and try and make a good return on your investment, and you're using the Tastyworks platform, which does all the calculations for you, you just want to keep these trades as a 73%, 70 or 68 to 80% is a really good probability of profit range. And if you see something like this, I could place this call spread in the money. So let's see, in the money, and hold on, right there is in the money, which are, I mean, that's going to be an expensive call spread, and we still only have a 33% chance of making a profit on this trade. Same would go for a put. So stay away from naked calls, naked puts, unless you got some inside information or you have a very, very strong opinion on which way the stock's going to run. I mean, sometimes you can push it to the wall on Fridays before the option expires. If it's running up real quick, you can get the contract real cheap because it's about to expire, and you can make a few bucks that way. But as far as a long-term strategy, you're best off just staying away from calls and puts, especially if you're new to options trading, because you'll end up blowing up your account really quick. But that does it for today. Be sure to subscribe to Texting Swing Trade. We'll be doing some live trading and plenty more trading tips. Thanks for watching, guys. Till next time.